Hello and welcome. Michael Scofo here, one of the partners here at Fortress Wealth Planning. And given the amount of noise in today's markets, we wanted to provide a brief presentation on the current state of the markets, how the markets have reacted to similar situations in the past, and to reinforce our philosophy and strategy to ease fears and position you for financial success. We believe that education and transparency are key to your long term success, and we hope to provide that to you today. There's a lot of events going on in the world today, including political, geopolitical, and economic, and they're all contributing to the rise in the overall volatility of the financial markets. One way to measure volatility is through the volatility index, or more commonly referred to as the VIX. The VIX tracks the volume of options traded on the S&P 500, which is a tactic investors use to mitigate the potential for losses or declines in their portfolio. We saw a spike in the VIX in early August due to poor economic reports being released, mainly around jobs. There's been discussions about a September rate cut, but the jobs report was worse than expected. And you may recall that the Fed has a dual mandate: maintain inflation and maintain full employment. And with the drop in the jobs report, there was some concern that maybe they waited too long and therefore potentially compromised the economy. That being said, volatility is still up about 35% over the past 3 months. Now, increases in the VIX are not unexpected with an upcoming election and closely watched interest rates and other events going on. So it's safe to say that volatility is here for the near future and one should expect it in their portfolio. Now, carrying on from the last slide, market movements around an upcoming election are very common. As we learn the likely president elect, markets tend to rally, has been the case going back 40 years to 1984. But uncertainty in markets causes volatilities as investors will continually buy and sell in the short term, mainly around headlines. It's important to note that stocks have ended higher 1 year post election in the last 40 years of elections. So keep that in mind. Now, we have summarized the data on this slide to illustrate that downturns are very normal and should be expected, and they should not be a reason to cause panic. Over a given year, the S&P 500 has experienced a decline of 5% in 94% of all years. Now, this chart goes back to 1928, so we'll just round that to roughly 100 years of data in a 100-year time frame. 94% of that time, the market's gone down 5% in a given year. In 26%, so roughly a quarter of all 1 year time periods since 1928, the S&P has declined 20%. So if we look at the averages, the sell-offs of the S&P since 1928, there has been a decline of 10% per year on average. And if we look at the averages again, there's a decline of 20% about every 3.5 years. They're completely normal and should be expected as an investor. Now, if you've worked with me for any period of time, you've likely seen me share this chart. It's one of my favorites because I think it illustrates that markets are resilient. We've faced recessions, we've faced bear markets, and on this chart going back to 1942, there's been 13 recessions and 15 bear markets over that time frame. The financial crisis of 2008 continues to influence investors, but it should be noted that this was really an exceptionally bad time frame, and that the entire financial system was under fire and almost collapsed. Most bear markets, which would be indicated by the yellow on this screen, have typically lasted just over 11 months. Let's call that a year. And the blue periods, the bull markets have lasted over 4 years. Now you can see that there's more blue on the page than yellow. Now, how these recessions and bear markets started, always different. How they end is always the same, and that's through economic recovery and expansion. The markets are resilient. They've proven to be the case in every one of these examples on this page. Now, in the case of a complete and total political meltdown, we'd be focused on things beyond our money because there would be much bigger problems in the world. A very unlikely scenario. Now, this slide is a carryover from the previous slide in that it talks about the war chest. And this is something that we discuss regularly if you're a client of the firm. It's our way to help clients manage the amount of risk that they're willing to take without sacrificing long-term investment growth in the case of fear selling. Now, here's the concept of the war chest. Think of it in the number of years worth of spending. So if the average bear market on the previous slide was, call it 1 year, how many years worth of spending should you have in cash? This way, the clients can focus on spending down their cash assets in the war chest, while we as the advisory team focus on replenishing the war chest in a way that doesn't harm the portfolio returns while keeping that long-term focus and also managing tax implications. We mention this process continuously, and it can prevent people from causing irreparable damage to their portfolio by selling in a down market. So this is really the way for us to manage or throttle risk. If somebody is not sleeping at night, we talk about increasing the war chest. We're never going to be advocates of completely selling out of a portfolio because it can destroy financial lives. But one of the ways to help ease some of those fears or discomfort is through increasing the balance in the war chest. Now, we cannot deny the fact that the possibility of recession has increased as of late. Now, if we go back to 1929, the markets returned almost 9% on average the 2 years following the initial recession. Down years provide long-term investors the opportunity to buy stocks at a deep discount and to take advantage of uh, loss harvesting in the portfolio. And you've heard us maybe mention this as tax loss harvesting. That's another way that it's referred to. Tax loss harvesting in the portfolio keeps the financial situation the same, swaps out investments, and allows us to capture that accounting loss and use it to offset future gains in the portfolio. Our philosophy at Fortress is a long-term strategy, and this chart should comfort you knowing that your portfolio will be okay and should prove resilient over time. If you have any questions and would like to discuss your particular situation in greater detail, we'd encourage you to reach out by clicking the link or to your relationship manager, and we'll be glad to set up a call to discuss your questions or concerns further. Thanks for spending the time with me today, and be well.